So let's move to the next session, which will be our last session, about how you can write and formalize this learning and experience process. So we need to go here to our video again.
From how you invest. I mean, really shift from just guessing and hoping for the best to using a powerful, structured strategy. Well, that's exactly what we're going to build step by step today. Let's dive in. First, I want you to think about something. That last investment you made, was it based on a really clear, repeatable system? Or was it, more of a gut feeling, a hot tip you heard, just a hunch? Be honest with yourself, because that answer, well, it's the key to everything we're about to cover. Look, if you answered a hunch, you are definitely not alone. Most people start that way. But that brings us right to the heart of the problem we've got to solve, because while a lucky guess feels amazing in the moment, it is a terrible, terrible foundation for any kind of long-term success. Here's the hard truth of it all. The market, over the long haul, doesn't care about your lucky guesses. It rewards consistency. And if your method is all over the place, guess what? Your results are going to be all over the place too. Relying on hunches is literally the definition of an inconsistent method, and it leaves your portfolio totally exposed to emotional whims and all that market noise.
Okay, so how do we build that consistency? How do we get that edge? The answer is actually way simpler and honestly more powerful than you might think. It all comes down to the simple discipline of writing things down. Seriously.
I absolutely love this quote because it is just so brutally honest. We all have ideas, right? Oh, this stock is a 10-bagger for sure. But you know what? An idea without a real plan is just a wish. The real value, the part that's hard, the expensive part, is in the disciplined execution of that idea. And writing is the bridge that gets you from one to the other. Now here's what's so cool about this. The simple act of writing forces you to get super specific. It makes you clarify exactly why you believe something's a good idea. It makes you check those hidden assumptions you didn't even know you had. And crucially, it makes you think about what could go wrong. And, this is a huge one, it makes you define your exit plan before your emotions are running high.
All right, so we get why we should write it all down, but what exactly are we writing? Let's get into the blueprint and see how we can turn this concept into a concrete, actionable plan.
Now, this is a really critical mindset shift. We are not writing down a hunch. We are not writing down a feeling. We are formulating a testable hypothesis, just like a scientist in a lab. I believe X will happen because of Y and Z. That simple change in framing elevates your entire process from something like gambling to real strategic analysis. And here they are. These are the 5 pillars that hold up any strong investment thesis. You have to be able to answer every single one of these questions, clearly, concisely. If you get stuck on one, that's a sign. It means your idea isn't fully baked yet. Let's just break this down a little bit more. What is the easy part, right? The name, the ticker. Why is the real meat of your argument? Is there a catalyst coming up? Is it just fundamentally undervalued? Risks forces you to be your own biggest critic. Success gets specific about your price target and how long you're willing to wait. And exit, that's where you predefine the rules for taking profits or cutting losses. This table right here, that's your pre-flight checklist. A thesis for a single investment is great, but the real power, the compounding knowledge, comes from turning this into a habit. And that's where we move from just writing a thesis to keeping an ongoing investment journal. This becomes your tool for continuous improvement. Now, before you even think about putting a single dollar on the line with your new hypothesis, you should try to backtest it. Go look at historical data. If this same setup, this catalyst, had appeared in the past, what happened? Now, of course, it's not a guarantee of the future, but it is an absolutely essential step to see if your logic even holds water. And when you're backtesting, ask some really sharp questions. Did strategies like this one actually work out in the past? Were there specific sectors where this signal was way more powerful? You're basically a detective looking for evidence, for patterns that either support or seriously challenge your hypothesis before you put real money to work. But listen, your journal isn't just for numbers and charts. In fact, probably the most valuable data you can possibly collect has nothing to do with price targets. It has everything to do with your own psychology. You've got to start tracking your mindset. So when you look back at a trade you made, ask yourself this. Was my conviction high because it was based on my thesis? Or was I kind of hesitant? Was I maybe just driven by a fear of missing out, FOMO? That answer is a super critical data point about you. Oh, this one is the moment of truth, isn't it?
You defined an exit plan in your thesis. So did you actually follow it? Or did you let a little greed or maybe a little fear convince you to bend the rules? The same rules you set for yourself when you were calm and thinking rationally. And finally, get real about your emotions. Were you feeling euphoric when you bought? Anxious, maybe impatient? Just naming the emotion that drove a decision is the absolute first step to recognizing and then managing all those behavioral biases that can wreck even the best laid plans. Okay, so you've been writing your theses, you've been journaling your trades, your emotions, the whole shebang. But right now, those notes are just data. Now comes the most important part, turning all that raw data into actual usable knowledge that gives you a real edge. The learning doesn't happen when you write it down. The magic happens when you review it. You have to schedule time to go back through your journal. What do all your winning trades have in common? What about your losers? Do you see a pattern? Like maybe you always get impatient and sell winners way too early. This is where you find your alpha. This is where you get better.
The legendary investor Paul Tudor Jones just nailed it with this one. The whole goal of all this work, the thesis, the journal, the review, is to fuel this unquenchable thirst for knowledge. And not just knowledge about the market, but knowledge about yourself as an investor. Your journal becomes your own personalized textbook.
If you only take one single thing away from all this, please let it be this simple mantra. This is the entire process in 4 simple steps. Write your hypothesis, test it against the data, track your results and your mindset, and most importantly, learn from it all so you get a little bit better with every single cycle.
So I'm going to leave you with this final thought, which is really a call to action. Don't just let this be some interesting information you heard. Put it into practice. Right now. Think of an investment idea you have. What's the first hypothesis you're going to write down and test?
Well, well, let's go back to our final discussion. And this is really a very interesting topic, isn't it? And probably a difficult one, because what we're saying here is that you should go back to your youth, or when you were a teenager and used to write your diary, probably with just your love life. But now you're coming here, a guy, a 70 years old guy, asking you to write a diary again, but not of your love experience, but about your investment experience. But the reason is quite simple, is that writing things down is really a very important discipline to learn. And, some people used to say about learning something, that a good way of learning about something is having to teach it. And again, in terms of investment, learning about investing throughout your life, the best way to learn is writing your own story of investment. So we have here a few points that tell you why writing is very important, and why we need really this writing. It's really because we need to have, first of all, we need to have conviction. I mean, there's no point in buying a stock if you really don't trust, you don't believe that stock. So if you don't believe, you need conviction. That's the first thing. The third thing is, of course, is that you have clear ideas. Have to be a clear mind about what you are doing, and don't be confused, be in a mess, touching here and there without really knowing where you are going. Just action for action, without a direction. So you end up in a slump or some other thing like that. So you really need the clarity, and you need consistency as well. So you need to be consistent, and sometimes even persistent. You need patience as well, of course. And writing helps you with all that, because it clarifies your reasoning. It lets you to check your assumptions, to anticipate your risks, and to define an exit plan. So this is really a very clever way of doing it. It's not just a teenager writing his love story. It's really someone who is willing and trying to learn by writing. But of course, this has it's funny because these days we are in a very peculiar situation. In the old days, you wouldn't write because I know you didn't like writing, or you didn't have a secretary to whom you could dictate your thoughts, your ideas, and she would clean them up for you. But nowadays, actually, it's much easier because you don't actually need to write them down in by picking up a piece of paper and a pen, but you have now all sorts of tools that allow you to dictate and have your ideas organized and typed without actually needing a secretary. So in a way, we are very entering a very new age where really you have a machine as your own secretary, and so your writing process becomes much easier, really. So if you want to do that, so it's just a question of habit. So if you don't have the habit, okay, then it's it's not so easy. But let's look here at some of the what we call the five pillars of investment of an investment thesis, and these are the typical questions: what, why, how risky, what is success, and how should I get how should I retain the gains from my investment. So these are the kinds of things that you should try to write down, or at least to consider when you're writing down your thesis about your why what you're doing in terms of investments. That is really an important. These are the important. You can even add these topics and then start writing on each one of these. And likewise, it's really very important that you also look at something that we may call the auditing of our emotions and our bias, actually, because we have emotions and bias. They are not necessarily the same thing. And especially our emotional mindset depends very much on the recent history and whether we have been more confident, more skeptic. Are we getting a lot of negative news, a lot of positive news? So how are emotions being played, not just by our personal personality, but also by the environment where we are in, the news we follow, and so on. So doing a kind of emotional audit is really can be useful. And when you take a decision, you can say, well, I was bullish, I was bearish, or I was uncertain. So actually registering your emotional status at the time you made a given decision or you select a given strategy can be very useful. And and especially the price doesn't reflect, as we show in this chart here, doesn't reflect your emotions. So if you were, let's say, bullish, but suddenly the stock starts tanking, then you have a conflict before your bullish sentiment and the reality of the market. So you have to be aware of that. So that's really. And the other thing is about the bias. We have already talked several times about our innate tendency to be biased in favor or against a certain stock. And in that regard, we probably should remember what some of the traders think, because traders usually don't like to know anything about the companies they are trading. And the reason is because they don't want to be emotionally attached to that company. So for them, a company is just a ticker. It doesn't mean anything else. It doesn't mean the people that work there, the people he knows there, the service and products that they provide to their customers and so on. So it doesn't matter for a trader, but for an investor, that's a different story. So for an investor, you may have bias in favor or against a company, not because of the price the company trades in the market, but because of the products. I mean, you will know about famous stocks like for instance, Google, Apple, that every year launches a new iPhone and make a big fuss about the new iPhone, the new things that, so there's a lot of, that's like a kind of religion. There's a lot of customers that are keen about that, and they judge the performance of the company based on on all the excitement or lack of excitement about the new model that is going to be launched this year. But that launch may actually represent maybe 1 or 2% or 3% of the sales of the company. So really shouldn't bear much on your investment opinion, on your investing opinion about the stock. And therefore, so you really need to understand what are your view about the company. And here you have really to take two different views, and different investors have different opinions, and they may be necessarily both right. So for instance, some investors only look at the accounts. They don't care what the CEO says. They don't care what the media says about the company. So basically, okay, they only believe hard facts. They look just at the financials. They don't care about anything else. And on the other hand, there are other investors that think they otherwise take the opposite view. They don't care what the financial statements say. So they simply go to the shops or to the and see if the customers are satisfied and the cash machine is the cash register is working a lot or not. So they take their advice from what they see in the shop. So they look to see what how the product is selling and so that. But again, if they don't know how much, a sale may be quite a hot sale, but if it's being selling at below cost, he will be losing. So it will be an illusion. So you need to do with that. So you should try to avoid this type of bias. Just numbers that matter, just the products that matter. But in fact, both of them matter. So you have to look if companies like, for instance, now these new AI companies which have get millions of new users, but do those new users mean new subscribers? And so that's the reality of the subscribers might be completely different from the reality of the users, and the user may shift to another one who offers the same or similar service free as well. So how loyal are the users and the subscribers, sorry, can be completely different. So you see, now this you have, that's why you can't be just partial to your bias in the relation of how to assess a stock on the financial side, on the customer side. So you have to be to look at both, really. I mean, you really need to look at both and take both into account. Okay. I think we have looked already. We talked about a lot about how skill and luck are important for investors. Just to remind you again that skill we can improve, lucky or unlucky. Unfortunately, we can't. It's out of our power to improve. So my suggestion is that okay, if we are lucky, good, so good. Happy to be lucky. No, not going to complain about that. If I'm unlucky, I'm also not going to to feel miserable and say, oh gosh, I always got the wrong side of the stick and so on. So I'm not going to do that. I just accept that in life we can be both lucky and unlucky. Sometimes we are more lucky than unlucky, but it's life, okay? But on skills, no, on skills we can do something about them. So we can really try to improve our skills, and that's the purpose of writing our investment ideas and thesis about what we are doing. That's what we do. So let me just then complete this discussion with a final slide somewhere here, which can help us to complete this journaling exercise. And the first thing you need to look is to have some kind of self-correction checklist like this one here. And the first thing to ask is, does your writing really brings clarity to your opinion? So you have to look at the reasoning, the assumptions, the risks, and so on. But the purpose is to have clarity. So that's the most important fact. Likewise, it is really a full story. Is it a complete blueprint or not? So you need again to look at the catalysts, at the success vis-a-vis the price targets and so on. And why are you backtesting? Are you really backtesting, or just looking at some historical data and that's it? So again, you have to check that. And finally, what are you tracking? Just the price, the valuation, the financial performance of the company, the sales performance. So you need to see what you track about the stock. Of course, the price is the thing that you everyone does. But in terms of tracking the price, you don't need to be, some of the old days investors would basically just look at the tape, the so-called tape, where the prices were passing, and basically based on that, or looking nowadays in a chart in a computer, and basically trying to anticipate using technical analysis, or not trying to anticipate where the price goes next, and poorly on the basis of the current and very recent past, without looking much further than that. And that's okay for day traders and so on, but it's not okay for medium and long-term investors. So it's very important that you look at the price, but remember that the price, you have to look at it over a reasonably long period of time, and the price story is not everything. You have to look at the valuation and the financial performance of the company, the sales performance of the company. So you need to look at all those aspects. So keep this type of checklist. You can expand, write your own type of checklist, which can be also a very useful tool for you to keep your journal. But as I said, the first thing to do is really to force yourself into keeping a journal, okay? It's really the first thing that you, because I know from my personal experience, we are really very lazy. We really don't like the idea of maybe because we don't have enough time. When we are young, we're teenagers, we have plenty of time, so we have time for everything, including to write a journal. But when we are older, we feel we don't have time, so it's we very often we resist the idea. I know that we resist the idea of writing a journal, but make the effort, okay? So try to do it and try your best.